Hello, everyone. My name is Rick Calvoda, co-head of Global Advisory at Altus Group, and welcome to this first of the quarterly market performance calls, first quarter market performance call. This call is a new initiative where we'll be discussing not only property return performance for the prior quarter, but we'll also provide insights into the underlying valuation trends that are driving those returns and the appreciation under those returns. The performance information you'll be seeing is for the NCREIF ODCE Index, and it covers all 27 funds, which includes one additional fund for this quarter. The valuation data that we'll be presenting is based on the 25 ODCE funds that we work with, but it also is based on the insights we gather from more than 10,000 valuations that we oversee each quarter on assets totaling more than 800 billion in gross asset value. By analyzing or looking at these underlying pricing and cash flow assumption changes, we're able to not only help you understand the value changes that occurred in the prior quarter, but also provide some real-time insights into the current valuations that are current valuations in the quarterly valuation process that are being completed right now. So to provide this insight to you today, we have two experts in performance and valuation analytics. Phil Tiley, who heads up our data analytics team, has over 30 years of performance measurement experience. And Robbie Tanjung, who heads our US Global Advisory Group, has more than 23 years in the valuation industry. So before I pass the presentation off to Phil, I'd like to first go through a couple of housekeeping items. First of all, we should have about 10 minutes at the end of this call to cover any questions that you may have. So please use the chat feature on this webinar to submit your questions, and we'll try to address them at the end. Secondly, as I mentioned earlier, this will be a quarterly call going forward, so you can look forward to the second quarter market performance call, which will be on August 5th, and you'll get a few invites between now and then, until then. And then finally, if you are interested in the analyses that are that you see here today, please reach out to your Altus rep, and they will put you in touch with either Phil Tiley or with Ali Asadi, who heads up our business development team. If you're a NCREIF member and you contribute data to NCREIF, then we're able to provide a comparative analysis on your portfolio to the NCREIF performance data. But if you're not a member, then either you can become a member, or we can provide a similar type analysis, comparative analysis of your portfolio up against Altus's valuation data that you'll see here today. So again, thank you everyone for joining. Look forward to seeing you on future calls, and I'll now pass it over to you, Phil.
Thanks very much, Rick, and hello everybody. Thank you for joining today's call. So as Rick mentioned, the core part of the presentation focuses on the NCREIF ODCE Index, and we're looking at the pure real estate side of it. So this is no leverage, no cash, net of fees. So it's looking at how actual real estate performance levels played out, leading up to more specifically during the pandemic and where we are now. We're taking the information up to the end of Q1. And we'll, as Rick said, the return information here we take from NCREIF, we then blend in information around the valuation data to give more insight into where there are variances in performance levels. So from a top line return, income and appreciation, the good news is that performance levels continue to move in the right direction into the opening 3 months this year. So you can see they're stepping up 40 basis points from where they were at the end of last year, 1.4 to 1.8% total returns. And appreciation within that is around just shy of 1%. So having turned negative back in Q2 2020, when the full effects of the pandemic were being felt, total returns have steadily eased back on an overall basis. I think one of the main takeaways we picked up from this quarter is that returns across each of the key property types are now positive across the board, retail's included, and the four major property types are all stepping up on an upwards trajectory. That said, there's still a huge disparity across the sectors, with industrials very much in a league of their own. You can see that 4.7% rate of return. That's a record high. It almost feels like I'm saying a record high every quarter when it comes to industrials, but that's a record high number. When we look back over the history of the Odyssey on a property level, it goes back to 2013. Closest rival to industrials on a quarterly basis and on an annual basis is that other grouping there. So just to explain within that, that's about 4% of the overall Odyssey index, so in terms of the overall quantum that you're looking at there. Just a slither of that is hotels. The majority share of it, over 65, around 70% is self-storage. About 20% of it is senior living and healthcare. We're also seeing the emergence of data centers coming into that category as well. And that, with the exception of hotels, they're all pretty much growth assets and kind of getting close to where the industrial market has been performing. Next up in the performance rankings, a little bit further drift, are apartments, multifamily, the 1.5% total returns. So appreciation within that is actually positive. And one of the transitions through the pandemic is apartments now getting the better of the office market, so to speak. So a bit of a changing of the guard there. Drill into that in a little bit more detail in a couple of slides. Offices remain subdued, but yes, they're up from where they were in Q4 to where they are in Q2 at 0.8% total return, but there's still downward pressure on appreciation within that number. And then retail's propping up the order at 0.1, but positive for the quarter. So for the year, you compound that, 3% return overall. And here you can really see the contrasting fortunes across the sectors. Even if you actually removed retails from the equation, you're talking about a 10 percentage point spread from industrials versus apartments and offices, and that's most probably a record spread that we've seen if you take things back historically. I'll delve into that a little bit more detail, but before I do so, just looking at the variance down the bottom here to qualify what we're doing here. So 3% is the annual return on real estate for the year. We're separating out from the stabilized, we'll call it the operating asset return. So reversing out of that the impacts of developments and significant renovations. So those kind of really actively managed assets account for about 6% of the average Odyssey portfolio. And you can see that that 6% is adding about a 20 basis point premium to performance levels. And that premium is being evidenced across the apartments, the industrials, and the office sector. So hopefully viewed as a positive indicator of the market delivering on its returns to investors. Back to that sector comparison and just kind of tracking it back to using this slide here that shows the rolling 12-month returns, just to kind of draw everyone's attention to that divide that's been opening up across the four mainstream sectors. If you go back to 2013, 2014, there wasn't a great deal to differentiate at sector level. Real estate on an annual basis, just delivering somewhere between a 9 to 11% rate of return. Apartments, the brick red color there is at the lower end of that performance ranking. But back then, retail's offices very much in growth mode. You get to a period of slower economic growth and things start to ease off a shade, with the exception of that green bar, which is the industrials, which has consistently on an annual basis been delivering a 10% plus rate of return to investors. We'll come back to that in a second. But if you strip this back just to the office and the apartment sectors, you can see how they've both eased off. Offices, that purple line, have generally kept their noses in front of the multifamily sector, especially through this kind of period of 2017 to 2019, when offices have values there have edged up quarter over quarter, whereas multifamily is kind of more flatlined from a value perspective and more just a pure income return play. But as I say, we're now starting to see a slight changing of the guard there. For the first time since 2013, that red line is just nudging ahead of the office sector. And office and apartment values are on an upwards trajectory, still downward pressure on office values. So I guess maybe, Robbie, to use, I mean, do you see this as a kind of transition of power? Do you think this is going to be the new normal? Will it revert to type? Obviously, I guess, I think knowing where I'm seated now in my house, I know what part of the reasoning is behind that, but maybe get your intake on that there, Robbie.
Sure, Phil. Like in here, this is a perfect illustration, kind of the impact on work from home, right? So office is closed, apartment is open, relatively speaking, right? So if you look in the beginning of the pandemic, both of them declined relatively similar rate. But as we kind of progress to 2020, office have a lot of uncertainty, right? So with so many company indicate to the employee that they can work from home permanently, versus like there's some certainty in the apartment front. Right? We still need a place to live, and our office, our apartment, and our home have become our office for the part of the 2020 period, right? So, and then you're coupling with the availability of financing on apartment front, so make that transaction volumes are coming back again. So in a sense, that stabilized the apartment faster than the office. Well, the office has started changing a tune, right? So they start opening soon, but they still have uncertainty on the office front.
Yeah, and we definitely cover off the effect of the transaction volumes when we can start to bifurcate that a little bit in terms of, as Rick was just describing, the kind of the fundamentals of the valuation data. We'll go into that, but I mean, I very much take your point about working from home or living at work, it feels like at the moment, but it's one way or the other. Just changing tact and looking, the other standout characteristic when you're looking over this period, I mean, it's well documented the challenges that played out in the resale sector. So that blue line there dropping away more so than anything else, and started to really drop away end of 2018. Contrast that with industrials, logistics, and the two kind of interlinked from an e-commerce standpoint. I thought what was kind of quite staggering is actually if you look at the total return variant there on a 5-year basis, that's an over a 12% per annum gap that's opened up between those two sectors for investors. Retail's thankfully now taking up, moving in the right directions, but industrials are actually even on a even steeper upwards trajectory. And actually, if you look at things here, just on the retail side, retail's returns, as you can see, now just turning positive. This is quarter-over-quarter returns, so I haven't seen that since kind of 2018, 2019, and after this kind of period of notable kind of correction, disconnect with the other sectors, starting to rejoin the pack, so to speak. But industrial still phenomenally strong. And actually this slide works well just to show that every one property type took some form of a nudge, correction, some more than others, during that kind of focal period of the downturn back in the midpoint of last year. So maybe just track back up to the top level returns. This breaks them down then into income and the appreciation element of those returns. Just a quick word on the income return. That did edge down a little bit, and it's gone up by about 10 basis points into the start of this year. So through 2020, it was running at about 1%. It's now up to 1.1. So reductions on those rental positions, which we'll talk a little bit more about, do have a near-term impact on the actual return levels. But the major variance on the appreciation return side, and you can see having gone through 3 quarters of negative appreciation, focal point of that decline in Q2 of last year, but now back into growth mode, 2 quarters of appreciation, and that positive appreciation in Q1, kind of getting back to levels that we're seeing back in 2017, 2018. So from a kind of net change in value standpoint, these 3 quarters of negatives are 2.5% down at an overall level, then 2 quarters of growth, 1% up. So real estate on a net deficit value around 1.5% over this period since the start of the pandemic. What we're then able to do with the valuation data is to provide a lot more insight into that appreciation and the return. So we transpose the red bar here onto the red line, and then we bifurcate that into the effects of what we term the yield versus the cash flow drivers. So the yield's yellow, the cash flow are the blue. So the yield influences are the change in pure pricing levels on valuation. So you're looking there at the impacts of the change in discount rates and exit caps. For cash flows, we're identifying the impact on value from the change in that forward projected 10-year cash flow trajectory, and whether that's kind of trending up or trending down. The third layer, the grey bar, is the capital expenditure, because from a return standpoint, you don't bank all that change in value. So that kind of 1 percentage point change in value is tapered back from a return standpoint because the ongoing money that's being spent, invested into these real estate assets, takes about 20 basis points off that. So they're the 3 components. So when you look to things going south back in Q2 of last year, the major protagonist there was that contraction in the cash flow piece. And a lot of that is adjustments on those cash flows in the near term. We'll cover that off when we open that up in a little bit more detail across the sectors. there wasn't a great deal of additional risk being priced into the market back then. Most of that's in the retail sector, but they definitely felt like the industry kind of almost acted in unison. I mean, would you say that's correct, Robbie? Did everyone take their medicine at the right time?
Yeah, I think that on here, right, everybody's come together pretty quickly this time around, right? So there's a lot of conferences, there's a lot of meeting, trying to understand kind of what the deal, what's the cash flow impact on all property type, even in first quarter, right? So at the end of the first quarter, there's a lot of reopening on appraisal to make sure that they capture some of the impact, but potential impact, right? So, and I think the discussion with the industry, the NCREIF appraisal, asset management, and trying to re-underwrite some of the deal, trying to understand the deal that kind of under contract before pandemic, why it fell through, why it kind of continue, right? So, and we progress through kind of 2020 to 2021, and then you see more and more transactions. So now you see that the increase is back again, right, with the appreciation kind of over the last 2 quarters.
Yeah, and actually to that point, the last couple of quarters, 2/3 of that upside is on that yellow bar, isn't it? So 2/3 of it's driven by what we might term kind of renewed investor sentiment. Although on those blue bars, we are maybe kind of clawing back some of that deficit on cash flow, but there's definite variations there across the sectors, because actually on the cash flow side, things do continue to tick into the start of this year on the downside. And actually there's variance there across the sectors that kind of dominate the overall. So if that's the overall, then this slide here looks at the 4 major food groups. And you really, folks on the call want to be focusing on the right-hand side of these charts just to get an understanding of the interplay on that yield versus cash flow position on that red line, the appreciation return. So that renewed investor sentiment, the reference back on that prior slide, very much targeted, as Robbie was alluding, at the apartments and the industrial sector. The flip side of that is those cash flow bars. The blue, with the exception of industrials, have continued to contract into the opening 3 months of this year. So the effects of the pandemic are being very much felt in that regard. I mean, to Robbie's points, that a lot of coming together in Q2, understanding the potential effects of the pandemic, corrections on growth assumptions on those rental streams being taken back in Q2. But as I say, we're still seeing some of that downside on cash flow playing into the earlier part of this year. And I mean, I've just spent the last couple of weeks talking to one-on-one with the ODCE portfolios, and the evidence of that is it's all around property specific. So whereas there's fundamental corrections back in Q2, opening part of this year, it's looking at specifics around individual properties where you got lease roll or just increased operating expenses that weren't realized previously. But just looking at the sectors, the apartments, there's real dichotomy there, isn't there, Robbie, in terms of reduced cash flow, direct counterbalance there by the positive price adjustment. And, I get it for the industrials because, I mean, there's that buoyancy around the kind of e-commerce side that's generating A, investor interest, and B, strengthening in rental positions. But there's a real dichotomy here on the apartment side. So maybe the thoughts on that there, Robbie.
Yeah, I think on the apartment front, and we still have the negative cash flow adjustment, right? So I think, but overall, there's two, what I call it, two main tailwind on the apartment front. One on the fundamental side, the other one on the capital market side. On the fundamental side, if you look at it historically, right, job growth is actually a good predictor of market rent. Right, so job growth have grown significantly in the United States, right? So unemployment today is at 6%. Many economists predict it to be kind of full employment by year end or by 2022, right? So with that job growth, basically now the market rent will kind of increase in the future. Fundamentals feel better, right? Especially in the Southeast, Southwest, the Sun Belt region, where there's a lot of job growth and population growth. The second thing is on the fundamental front, like inflation, right? So people have been talking about inflation. It's already hit an apartment on construction cost side, right? So lumber costs all-time high, steel prices, labor costs. So construction costs have increased significantly. So a lot of the project now no longer pencil out. So what that will do now, reduce the future supply, especially in the near term. If you look at historically, the apartment appreciation relatively flat line. Well, one of the reasons for this flat line is that supply issue on many of the market, right? So with less projected supply in the future with the construction, that will help the market rent in the future as well, right? So with fundamental appear better, like projected to be better in the near term, guess what? Investors coming back, right? So you look at the transaction volume, So that's why I said the second one is a capital market, which come from the fundamental side as well. The transaction volume on the fourth quarter 2020 already exceed fourth quarter 2019. First quarter 21 volume is already very similar to first quarter 2020 volume, right? So, and it's investor coming back, targeting Southeast, Southwest market, you coupling with the low interest financing, right, from Freddie and Fannie, some of them in the low 3, and even some of them in sub 3 interest rate, right? So with that, it drives cap rate lower, right? So it doesn't mean there's no headwind. There's still headwind on the apartment front. If you look at it, the cash flow are negative, and one of the main reasons for that cash flow negative, back to inflation, right? So increase in expenses, right? So property tax is higher, labor cost is higher, insurance cost is higher. Insurance costs also kind of, in a sense, it kind of go with the replacement cost new. As construction costs increase, replacement cost new increase, insurance increase, right? So, and the second headwind is gateway market, right? So the pressure in the gateway market, while there's improvement on people coming back to the office, but it's still unknown how many % of people will come back, how is the opening going to look like, are people going to stay in where they move to, right? So in gateway, definitely still have pressure, but overall, it's overall still positive on the apartment front.
Yeah, no, it's good. And on the office side, I mean, it almost looks like things have flatlined there, but obviously, yeah, we'll show in a few slides. There's a fair amount of variation within that. But I mean, I think the one thing on the office market, Robbie, we just haven't seen that movement of the yellow bar. It looks as if people aren't pricing in a huge amount of additional risk into the office sector. It feels almost like people are kind of in wait and see mode. Is that fair to say?
It is, but partially as well, basic, what people didn't realize is an office lease term is more than 6 years, right? So there's a lot of adjustment in terms of the shorter term, kind of higher concession, higher TI, right, on the cash flow front. If it's an average lease term, 6 years, only impact an asset that have a role in the first 2 years, right? So with the one with vacancy, right? So, and the other thing as well, what we will discuss later on, the life science, right? So the life science have been growing. That's in a sense covers some of the weakness in the CBD market, right? So the tone on the office have changed a little bit as well. If you look at 2020, a lot of the work from home permanently, right? So now all of a sudden recently work from the office permanently, even like hybrid method as people kind of going through now. As that tone a little bit improve and transaction have improved as well. So you see select transaction in the gateway market. Even Chicago, there's a couple office in the market today that an office that kind of well leased office, core office that's being kind of based on discussion. There's a lot of interest on, right? So several notable ones. So the other one is Uptown Station in Oakland, leased by Square. So pre-pandemic, that asset was under contract for $405 million. Recently closed in March for $419 to $420 million. So that's already higher than pre-pandemic price. The other notable transaction is the Highwood property transaction, 7 office, 5 of them core in the Southeast market, right? So the Sun Belt market, Atlanta, Raleigh, and Charlotte, indicating pricing on that 5 core asset is in the low 5 to mid 5 cap rate, right? So you can see that overall, the core asset well leased, you still get a lot of interest on it, right? So with kind of in comparison to where the bond market is on the well leased asset, and the other, but they're still unknown, right? So the unknown is what is the demand going to look like? So going forward, even though that's improved from last year, but there's still like, okay, what is hybrid method going to look like? What is the demand office going to look like? There's something we're going to continue to monitor going forward.
Yeah, no, as I said, there's a fair amount of variation. We'll come into that in a second. The other trend is obviously on the retails. I mean, having gone through this period of kind of disconnect with the other sectors, I mean, the positive point is that level of decline is easing off. Still a bit of downward pressure there on cash flows. There's still a little bit more risk being priced into that sector, but very property specific and levels of decline easing off. Next slide is just going to add a little bit more detail, a little bit more color into those metrics, especially on the cash flow side. So just focus on the movements on Q1. So the variance on appreciation ordered kind of top to bottom there across those major property types. The positive adjustment on pricing that Robbie was referencing there, but the variant really, the correlation is more on the cash flow side. So increasing for storage, that's mainly most of other and industrials, but still downward pressure for apartments, offices, and retails. And we'll look at this for the quarter, but we'll also look at it for the year. But this hopefully gives everyone on the call better sense of how we use that valuation data to then feed into those performance trends. So that cash flow variance is the key determinant between a lot of the upside and the downside. We then relay that through to a number of key valuation metrics. So I guess folks on the call would be pretty familiar with. Now, this isn't a perfect science, so you can't sum these bars to get to the numbers on the left-hand side. The color coding just gives you a sense of where the upside and the downside has been occurring in the opening 3 months of this year. That's kind of propelled forward the cash flows and the strength of the values for the industrials and mainly the storage, but kept things a little bit in check for apartments, offices, and retail. So this is percent point changes across these metrics. So occupancy levels now trending up for industrials, downward pressure for offices and retails. It's only really that on contract rents, it's only the retails that have come down there. On the market rents, still strong and improving for industrials and mainly storage. Starting to see some downward pressure on those upfront market rents, and for the apartments and for the retails, less so for the offices. And really where we've seen that kind of reduction in the opening kind of 3 months this year is what's around this metric here. This is this year one operating expense ratio. So this looks at the projected out kind of 1 year of operating expense to projected out 1 year of gross rent. So looking at the expense load on that revenue piece and how that ratio has moved from where it was in Q4 to where it is in Q1. So where it's spiking out, one of two things is occurring there. Either increased costs are being assumed or reduced rents are being now further taken into consideration. Robbie, you've already talked there about the increased costs that are still being picked up, and that's certainly playing out there in the apartment sector. One of the positives I've noted from this quarter is this rent growth. So this is that 10-year projected out rent growth rate and how it started to trend back up again. I'll show you in a second where that's been over the course of the last year, but you can see that movement out and the upside there. And we break that down to year 1, year 2, year 3. You can go all the way to year 10, but most of that correction back out is on that year 1 position. We're not talking a huge quantum. It's like 25 basis points for retails, about 20 basis points for apartments, but they're starting to see some positive trends coming through in that regard. Look at the situation for the full year. So from Q1 2020 to Q1 2021, and that's where a large part of the offset is being picked up. Trimming back those future projected rent growth assumptions, and a lot of that correction in the near term in that year 1 position. So retail rates going down just by a short of 150 basis points, offices by about 160, apartments on the year 1 rates going down by 70 basis points. And it's that, and also this year 1 operating expense ratio where we're picking up increased projected costs, reduced rents, and that's rent deferrals, rent relief, pushing out leasing assumptions, all part and parcel of the challenges that real estate's gone through within the pandemic. Add into the mix that you've got those upfront face market rents going down for apartments and for retails, which has then hit their cash flows slightly harder. On the office side, those market rent positions kind of holding their line. Understandably, the year 1 positions have been trimmed back, but I guess to your point, Robbie, longer lease structures kind of affording them a bit of protection, and then seeing that kind of continual tick up in those contract rents with those rents still being paid. Is that a fair summary there, Robbie? Anything else that you wanted to throw around that slide?
Yeah, I think on the office side, that's just a pure face rent, right? But in reality, on the modeling side, there's also rent concession and higher TI that's not being picked up by this chart, right? So it's a little bit deceiving. The net effective rent is actually lower.
Kind of all in there, isn't it? Yeah.
Exactly. And then the other thing as well, the retail front, but it's not necessarily the increase in expense of retail. It's just basically a significant reduction in revenue side. So that's why the OPEX increase.
Yeah, no, exactly. Okay, let's go down in a bit more detail. And apologies to everyone on the call if there's a lot of colors here, so maybe too much detail. But just let me navigate you around this chart. So we're looking back at the overall total return. So that's back to that 1.8% total return on the Odyssey. This is Q1, and how that return ranges across the individual sectors, and then how those returns kind of vary out across the 15 largest CBSA markets, and what isn't in those 15 is thrown into that other grouping on the right-hand side. And the color coding here denotes whether their returns in each of these groupings are running above or below their respective sector averages. You've got the Q4 numbers in below that, same table, but just corresponding returns that have been delivered back in Q4, and the one minus the other is at the bottom. So the color coding there just denotes whether things are trending up or trending down. And majority of those squares are green. Returns are generally starting to pick up into the opening 3 months this year. But there's variance there across the sector. So let's maybe just quickly talk across the major food groups and the variance in the kind of the geographic returns that we're seeing. So green spots there for the industrials. I mean, these industrial returns are all north of that 1.8, but there's variations within the industrial sector. Some of those west markets, San Francisco, LA, I mean, Inland Empire has been a real stellar, and that's up at 7.4% for the last quarter. New York and New Jersey has been a continual kind of strong aspect of the industrial sector. We saw that again. Contrast that with some of those kind of red shades, so more subdued returns across some of those more inland markets. I'll maybe get your thoughts on those in a second, Robbie, and we'll go through them in a little bit more detail, but let's just run through the other sectors as well. Offices, there definitely looks there like there's a east-west, greens on the west coast, but more resilience there. Boston, a nice green pocket there. There's the west coast, I guess there's some technology-based kind of credit bond type leases coming through into those numbers. Life sciences definitely a kind of a component on the upside that we're picking up. That's certainly that life science, medical, Cambridge area, Boston driving that. San Diego also a beneficiary of that. And I think also San Francisco to a degree, we kind of expected, I think everyone was expected maybe San Francisco to take a bit of a knock, and it did back in Q4, kind of folding in there with New York and the likes of Chicago, but it was propped up a little bit more in Q1. And I think looking at the detail there, there's some life science assets that have moved that needle. On the multifamily side, the major pressure points, some of those major gateway markets, San Francisco, New York, Chicago, definitely an urban theme. So into some of the lower ends of those numbers, will turn to the urban versus suburban in a second. But the green shades there around those Sunbelt markets delivering some pretty robust rates to return, and some of those kind of Sunbelts also play into that other grouping on the right-hand side. The retails, the variances largely around the more of the sub-property types. So we'll turn to that in a second. But I mean, just in terms of those variances, maybe we'll just take them back into a little bit more detail, Robbie. Just go to the apartments and bifurcate that again into those kind of using that valuation data, the yield versus the cash flow, and the variances that we're seeing there. So maybe you want to pick up on that one there, Robbie.
Sure. And if you look at on the bottom, right? So majority of that bottom is a CBD market, right? So Chicago, San Francisco, New York, CBD market seeing the pressure still on the cash flow front. On the other hand, on the top part is what I call the Southeast, Southwest, the Sun Belt market, right? So they're doing pretty strong, right? So especially with overall job growth, investor demand, people feel comfortable with that fundamental. Guess what? People chasing after that. Now you see significant pricing compression there, right? So and then the impact on the cash flow front is mostly increasing expenses as we discussed, right? So while fundamental have actually kind of rebounded on that market. So.
Yeah, but we're also seeing this, aren't we, as well? We're just putting out the market rent data, resilience on those market rents at the top end of the order, ones down the bottom, those gateway markets. That's where these are the upfront face market rents. That's where we're starting to see a decline. And if you cut into the CBD elements of those, there'll be more red to the left-hand side. What about the industrials there, Robbie? Because it's kind of double bubble there, isn't it? I mean, positive pricing, strong cash flow. Everyone's a winner, aren't they? Well, but there's obviously variation.
It is all tailwind, right? I know we didn't discuss it earlier, but generally there's a lot of tailwind on the industrial, right? So e-commerce sales is all-time high last year, and then you add on supply chain issue with seaport kind of volume higher than 2019 already, right? So definitely a lot of you get supply chain issue, you got e-commerce increased demand. guess what? The cash flow front, right? So if you look at that increased demand for spaces in the market with limited supply, in the coastal market. So in here, do I look at it? The top part is a coastal market, the bottom part is non-coastal market, right? So being in Chicago, it's always the lagger, right? So you can see the cash flow impact is always minimal versus the Inland Empire, which is kind of in a sense like where the vacancy is 2.5%, the rents continue to go up in that market.
Yeah. I mean, there's a real change there, isn't it? The rents and the rent growth, top end there, San Francisco, Inland Empire, labeled up as Riverside, and then down the bottom end of the order, still positive, but they're pretty subdued there. Dallas, Chicago, Miami, and actually rent growth assumptions being edged down a little bit there, but maybe just one few assets swinging that one. And then on the office market, aggregated out, it's all flat line. Look at the variances, and you do see both on the upside from a cash flow and a pricing, positive price adjustment, strengthening cash flows, downside those lower markets, and maybe more interested to run this. And this is 1 quarter, but maybe on the year, contracting cash flows still in the opening 3 months of this year, and a little bit of risk being priced into those markets. Your thoughts there, Robbie?
Yeah, I think this chart is a perfect illustration of the impact of life science to the office market, right? So if you look at it, the office cash flow appear minimal, but in reality of it, if you kind of look at the top part of the market, that's the life science market, right? The San Diego, the Boston, San Francisco, and Phoenix is more medical office market, and they have a positive cash flow. First, the bottom side is what I call it the CBD, and then the area with high vacancy market, right? So there you can see continue kind of a negative cash flow. So they definitely, the life science actually cover a lot of that averages. So it appears that office is not as bad, but if you break it down, they're definitely a different spot here and there that perform differently.
Yeah, and actually, when you talk about the CBD, it's a nice segue to the next slide, because in here we're looking within those geographies at the near-term locational trends for apartments, and part of that for offices, and part of that comes through in the apartments here. Apologies for the folks on the call, these are pretty small typefaces there, but on the offices we're breaking out the CBD versus suburban. For the apartments, high rise, low rise, and garden. So there's a sense of urban versus suburban in those numbers. The numbers down here are the weights, so don't confuse those with actual returns. The CBD office market isn't delivering a return of 19.6%. That's the actual quantum that they account for within the overall ODCE index. So CBD versus suburban, there's definitely the variant there in terms of that suburban return. Up, I think that's 1.2 for the quarter. So values within that holding up, whereas CBD return 0.8. So values there definitely coming under downward pressure. Actually, if you run that for the quarter, if you look at that for the year, you can see that CBD return is actually negative. We've extrapolated out MOBs as best we can using our data, and you can see that they're almost a totally different dynamic to the wider office market. That dotted line is the overall ODCE. So everything really in the office market coming below the overall ODCE MOB, very different in terms of its performance trajectory there. And then on the apartment side, you've got similar variances, and the apartment return is very much been propped up by the garden, the suburban assets versus the high-rise properties that have seen further downward pressure on values. Pretty much everything in the industrial side is actually coded up as warehousing. But on the retail side, things are starting to see some green shoots, Robbie, maybe now. What do you think to those numbers? A bit positive.
Yeah, so do I look in here is about kind of open air versus enclosed, essential versus non-essential, right? So if you look at on the neighborhood side, they've been holding up relatively better during the pandemic. So you can see some green shoot with kind of people putting transaction on the market. So seeing a better interest than people anticipated, right? So versus enclosed side, which is regional. I think if you go to the next slide, might be better.
Yeah, sure, yeah.
Show for it, right?
There's the hit for 1 year, and there we go. This is the makeup, isn't it? That's
exactly. So yeah, so if you look at non-mall versus kind of the non-mall versus mall, right? So the non-mall basically go to flat line now. So definitely improvement from the grocery side as people put in the market, and definitely more interest on it, right? So they didn't kind of go as bad because it's open, right? So essential, they consider essential center, right? So versus the mall have been closed, right? So although the consumer have kind of traffic have rebounded, sales have rebounded, but still lower than pre-pandemic time. It is a little bit more asset by asset. So you can see during the fourth quarter 2020, right? So the regional mall have a positive cash flow because people start doing redevelopment on the asset, right? So there's a lot more kind of like a redevelopment going on as well. And you're going to start seeing that in the future as people incorporate that redevelopment aspect to the cash flow.
Sure. Actually, those values have turned stable there. We haven't seen that in the retail sector since 2018. So yeah, definitely some green shoots starting to come through, and as I say, retail's starting to join the rest of the pack. The final few slides really just look at the structural composition of these portfolios that make up these returns. But as Rick mentioned up front, this data set, we analyze each of the ODCE portfolios against that. So we're looking at those portfolios in terms of how they're performing within their specific property types, and also the geographical slants and the near-term kind of slants where they've got urban versus suburban, where they're exposed to some of the gateway versus the Sunbelt markets. That all comes through in using diagnostic approaches such as attribution to get a sense of why a portfolio's return is different from the overall. And you could take that down to and it's the valuation data that then gives that extra detail, because that's the why, that's the kind of what, but the why is now what's the lever behind that in terms of the movements in the yields and the cash flow levels. So that same kind of top level view that we provide on a performance standpoint, you can very much take that down just to the value change standpoint. So anyone on the call that's kind of interested, as Rick said, to explore this a little bit further was around their own portfolio to get a bit of comparative analysis around this, we'd love to have that conversation. Obviously, if you want the full return chapter and verse, data pass through to NCREIF and we can do the full analysis. But just even on the value change, because obviously clearly that's the major variant, we can drill into that and understand portfolios and how different they are from the overall. So yeah, as Rick said, please do contact your kind of client lead and straight through hopefully to myself. In terms of the structural weighting of these portfolios, looking back to 2013, I think from my geography days, this is called a stand diagram. So ordering the markets up here from west to east, the top lilac there is the outside the 15 largest, and then you can see the capital weight in terms of how much they've altered. It doesn't look on the face of it like there's been a great deal of alteration in terms of the weightings of those respective kind of metropolitan markets. A little bit more kind of slanted now towards the West Coast. San Francisco has been a bit more of a growth on that one. In terms of on the east side, DC, dark blue, New York on the brown shade, kind of trimmed back down a little bit. Boston has definitely grown in its representation. That's at an overall level. You start to look at things across the individual sectors. Then if you go to the apartments, focus here on, that'll be Phoenix and Denver. They open up a little bit more, so a little bit more weighting in Phoenix and Denver, as you most probably expect on the apartment side of things. West Coast have certainly started to expand out a little bit, San Francisco, LA. Now, part of these changes in weights are going to be driven by the just changes in valuation trends, but also it parts of it down to investment kind of plays as well. The next layer that we want to go back to, hopefully for next quarter, we to look at the investment kind of activities and how much they've played to changing these kind of structural compositions. DC, New York on the apartments kind of being trimmed back. Miami, Atlanta, Sunbelt markets increasing in their weights. On the office side of things, that kind of top lilac bar has definitely grown. There's growth markets there. There's investors definitely putting more money into maybe what might be termed the non-primary markets. There's again increased exposure to some of those West Coast markets at the top. Definite shrinkage to DC, and that'll be kind of partly organic and given there's just the return levels, and that's pretty much flatlined while others may have grown in value. Whereas New York's also trimmed back, maybe at the expense of Boston taking a bit more of that market share. And then on the industrials, that kind of West Coast Pacific, just the kind of quantum that's invested there is worth of note. And again, that lilac bar quite significant when you're looking outside the 15 largest CBSAs. Chicago, where you are, Robbie, definitely being reduced back down there. New York, New Jersey, flip side of that, and we've seen those strong returns, and that's definitely increased the weight, but also increased the investment activity in those markets. But up here at the top, this lilac is often kind of gets a lot of interest. People are kind of curious about the major primary markets, but you get outside the primaries, and there's still pretty big metropolitan markets in there, but it's quite a large chunk. So yeah, we've opened that up actually just for the apartments and the industrials. This is for the last 12 months. So look at the weights that non-primary group accounts for of the apartments and for the offices, but also the return as the quantum that they're delivering. So they're delivering 2.9% return overall. So that's north of the 2% that apartments are delivering for the last 12 months. So there's some strong pockets there. I guess thoughts around what else is in there, Robbie?
Yeah, and here it's very similar theme, right? So it's the Austin and Charlotte being positive, again, Sun Belt market, right? So we kind of talk where the job growth market is. So that's how I kind of look at it on this other market, is where the job growth is.
Yeah. And then on the industrial side of things, even the other side of the pond, I could spot these three: Baltimore, Philadelphia, Trenton. These are the three largest. I've even learned that's called the I-95 corridor. So yeah, look at those returns, near 20%.
Yeah, yeah. Well, look, it is a spillover from New York, New Jersey, right? So you see New York, New Jersey have been super strong, as it kind of got not a lot of supply there. There's barrier to entry, like kind of low vacancy, and it's kind of spill over to the neighboring kind of market. So.
Sure. Okay. Rick told us that there will be 15 minutes of time for discussion, so I think we've eaten into that a little bit. Just some takeaway points. But I mean, my take is we're talking positives here, really, in terms of improving returns, 2 quarters of appreciation, positive returns across each of the property types. That's partly renewed investor sentiment. Cash flows are still coming down, but nowhere near as much as those corrections we saw back in 2020. And there are some within the sectors. There's definitely plenty of reasons to be cheerful there. I mean, in coastal industrial markets. West Coast offices, Boston, Sunbelt for multifamily, into that non-primary market. There's still kind of jury's out maybe in terms of, and returns are still lagging on the CBD offices, gateway apartment markets, malls still kind of feeling a little bit more pressure, but feels to be definitely more upside than downside coming through these numbers. And obviously the bottom in there, retail value stabilizing. I think people are maybe breathing a sigh of relief around that one. But yeah, I don't know if anything's come through on the chat line there, Rick. But and obviously, we will definitely share this recording out with everybody. But we're happy to pick up any questions that folks have been firing through.
Yep. No, thanks, Phil. Thanks, Robbie. Very, very helpful. Very interesting. Definitely got some questions here. Maybe first of all, talked about just office being, a lot of still questions and uncertainty out with office. You showed where base rents are actually similar or higher even in some cases, but it's due to concessions. When are people seeing, or where are you seeing investors making the assumption on those concessions? How long out do they continue? When do they fade away? And what's the impact to value on that?
Yeah, so it is over the next 2 years, right? So basically, what investor incorporate higher concession, higher TI in the next 2 years, right? So, but as I indicated, the average lease term is in the Odyssey is more than 6 years, right? So a majority of the office, like basically, if you have roll in the near term, you're gonna see that impact of concession, but if you don't, you're not gonna see it, right? So that's why and that's also show as investor willing to invest into longer term credit kind of office building, right? So if you get no roll in the near term, they feel fine. So and even the cap rate now, in a sense, that lower than pre-pandemic, right? So that delta is going into the CBD market, but just if you look at just an average overall office, it get covered up by the life science building. Like life science building, the rent's been going up, the cap rate been going down, right? So there's a lot of transactional activity there as well.
So actually, speaking on that, another question, if you go to slide 21 on life science, there's a question where life science shows up on that slide, and I think you just answered it, Robbie, but Phil, I think it's in the office, right?
Yeah, be in the office. So most of those will be, I mean, the life science at the moment, and there's conversations with NCREIF happening in terms of where they're being categorized, and as we've spent the last 3 weeks talking to the Odyssey portfolios. The vast majority are being picked up under offices. A few of them have been being picked up into that other bucket, but the vast majority are being picked up under offices. I mean, NCREIF will actually kind of formally separate them out within a sector so we can break them out. So we've just broken out the life science, we can identify the MOBs there within the offices that we can identify. But going forward, there's going to be greater clarity around that, but the majority we see fall into that office sector.
Okay. The industrial, I think you mentioned, just some of the top, quarters of performance, for industrial. It seems like every quarter is the same story. It's by far, it's been a while now. It just continues to outperform. Question is just how long will that continue? I mean, obviously fundamentals are still strong. There's still demand. There's still building, all that. What are you seeing in the marketplace just in terms of industrial and when does this slow?
Yeah, on the industrial front, right? So it's kind of going from the e-commerce increases, right? So even though e-commerce percentage have declined from its peak, but going forward, the retail sales percentage from e-commerce is going to be high, right? So, and then as it go high, people need warehouse spaces, and then plus a lot of the supply chain issue, people are going to increase inventories. It's going to increase more demand for warehouse. Vacancy in coastal market are really, really tight, right? So if you look at it, Inland Empire is 2.5%. Like some part of LA, like Orange County, I saw it's like less than 2%. So that vacancy are really, really tight. There's not a lot of availability. And it take a while until you can build new kind of the new warehouse, right? In some places as well, you have to go further out. There's a lot of barrier to entry in that coastal market. So I think a coastal market is going to continue on the market rent. Like a lot of people indicated, they have not found the ceiling yet on the market rent, right? So because if you have a vacancy in the market, like in an Empire, more than 100,000 square feet, you might be the only space out there that's available, and there's a lot of people trying to go after that space, right? So therefore that and the other thing as well, rent as percentage of doing business for a lot of tenant, a pretty minor number, right? So therefore they're willing to pay kind of even higher number, and that's what's driving a lot of the industrial side, both on the cash flow front and then financing front, right? So with the bond yield being so low as well, right? So in comparison, people can borrow money basically at really low rate, right? So you get cheaper financing, higher demand, and then it's take a while until that's new supply catching up. So my guess in the near term, over the next kind of like a year or so, you're still going to see that pressure on cash flow going up. So.
Well, I think just back to the demand that you're seeing, all you have to do is look at the coastal markets and see the cargo ships that are lined up to unload goods, and it flows directly. So maybe we start an index on just the number of tankers in LA here that we're waiting to be unloaded. Maybe along that lines, you talked a little bit about inflation and just the impact on valuations. It is and how that flows through in terms of higher costs to build, lower supply, then it results in higher rents, but also an offsetting impact on just higher expenses. Are we starting to see some of the impact? The inflation has really popped up as a discussion point over the last couple of months. Are we starting to see some of the inflation effects in values yet? Or is that something that when inflation actually occurs or occurs more, that we'll see it at that point?
Yeah, I think it happened on the cost side, right? So it happened on the construction costs already happening. It start happening in expenses here and there, right? So we start seeing that. But overall, like financing is still available, right? So the other thing as well that people kind of look at in real estate as a good hedge to inflation, right? So there's a lot of analysis or white paper kind of putting on real estate on both cash flow and value, kind of running NCREIF versus inflation. It showed that a lot of the assets are a hedge on inflation side. I mean, previously they kind of look at retail as a hedge, but retail have changed a little bit. So I would look at industrial as the new retail, right? So if you look at it, that's historically have been a hedge to the inflation. So that's why like investors are much willing to invest into real estate with the cap rate. They feel that if inflation hit, the rent will go up as well, right? So everything will flow through. The rent will go up. That's hedged. Then your income stream will kind of increase, right? So even though possibly inflation increased, the cap rate might increase or cost might increase, but the cash flow side will help increase that as well, and then will further reduce future supply just because construction costs will go up, right? So.
Okay. Maybe Phil, this one is on apartments. Gateway versus Sunbelt. You talked about markets. You talked a little bit about that. What about CBD versus suburban? And maybe especially now as we're seeing signs of reopening, are we seeing that impact reverse or change, just in terms of where everybody kind of vacated the cities, went to the suburbs or went elsewhere, tier 2 markets, now starting to come back? Are we seeing any of that shift coming back in terms of
on the apartment side? Not at this juncture. So I mean, most of the performance start, and it's hard as well because the way it's categorized up on the multifamily is high rise versus low rise versus garden. So there is a hint of urban versus suburban there. But when we're looking across the portfolios, it's those portfolios that have more of a slant in those suburban assets, even in some of those gateway markets, that have kind of led the returns in the apartment sector. So the suburban has definitely been where the kind of the focal point for the demand, and where we're seeing that yield, the yellow, where we're seeing a lot more of that positive pricing adjustment at the moment. But yeah, who's to know? At some point, those apartments in those downtown areas will fill again, I'm certain, once people do start to return to the offices. So, but the investor interest tilt at the moment has been very much into those suburban markets. That's we've not seen that alter at this stage.
Okay.
Yeah, I think to add to Phil, right? I think investor hate uncertainty, right? So at least like basically in the southern market, suburban market, they kind of have more certainty with the job growth, right? So with the gateway urban market, what Phil mentioned, is still unknown, right? So there's still uncertainty. What is the property tax going to look like? How are people coming back? I think that's uncertainty versus more certain in the south with the job growth. Yes.
Okay. Another question on Chicago suburban office market sales. Any? I think you mentioned the thing there. Can you comment further or provide more detail or your thoughts on suburban office?
Yeah, I think they put it on Chicago. I think there's a handful, or maybe one or two that put on the suburban office. It's still new in the market, so people are still looking what the interest on that. What I mentioned is basically this in the CBD. There's one in CBD. There's a handful. There's two in CBD market that's being put on the market. They have a high interest on, right? So suburban is a little bit tricky. Like just Chicago generally underperform, right? So you have to be. I think this one that they put on the market is well leased asset. Still too early to tell at this time.
Is tax still a focus in Chicago where it's having an impact, taxes?
Yeah, I mean, it might not hit right now, but most investors kind of avoiding Chicago just because they know eventually they're going to hit, right? So property tax will have to increase just with the fiscal issue. It's already increased before, right? So with the pandemic, that reduced the revenue to the city and the county. Even though they might not hit now, if people anticipate it will hit in the future. So that's why you start seeing that, and in apartment, like people increasing kind of the forecast on property tax in Chicago.
Okay, and back to investors just don't like uncertainty, so there's definitely
exactly
around that. And maybe this actually, SFRs, we hear a lot more about SFRs and even some interest, in some of the funds. None of that is in here. There's nothing yet, right? Okay.
No.
Okay. Because it's.
But we do get asked it. So on our virtual road trip across the 25 Odyssey funds, there's interest to understand the dynamic of SFRs. So I guess watch this space.
Yeah, well, definitely a lot more interest. We've working with several funds now just over the past 18 months. Definitely focused on that search for yield and housing, shortage. So that all flows through. So that's all the questions we have. So maybe I'll just give you each like 30 seconds to give kind of a synopsis as whether it's first quarter, how you see first quarter, but then probably more importantly, how you see that flowing into second quarter in terms of returns.
Well, shall I go first, Robbie? I mean, in terms of, I think, we're seeing this kind of upwards trajectory at the moment. There was quite a bounce back in Q1, and obviously that's driven by that investor sentiment apartments in the industrials. I think if the return does edge a bit higher for the Odyssey, I think it might be, my thought is it might be down to what happens down here, is that the levels of decline here maybe ease off a little bit. What Robbie's just mentioned about transactions in the office market, we're seeing things, we're starting to see some green shoots around the retails. So my kind of focus is always on the negatives, and how much the negatives are less, then I think, you know, I think we're kind of, we'll most probably continue to see the kind of performance levels, if not pick up a little bit higher. I mean, the one thing I would say when we're looking at all the portfolios here is, you know, that you've seen the variance here, and when we apply that attribution piece, you know, allocation versus selection, where funds are located, different metropolitan markets, urban, suburban, is at this point a real differentiator more than the property specifics, especially when you're looking at things like the apartments and the office sector. So yeah, it's, yeah, there's a lot to take in. But in terms of overall return levels, I think you've got to continue to feel quite positive about this. And these portfolios have delivered what they're meant to be delivering. The net deficit on value through the pandemic, 1.5%. I mean, the balance across these four major food groups means that things, you know, have held out and hopefully will continue to tick up. Sorry, I maybe took too much of that answer there, Robbie, but you can pick it up, and I've just eaten into the hour as well.
No, completely fine. So do I look at it? It's the same what Phil indicated, right? So it's been positive, I think, the first quarter, mostly driven by industrial. I think that as people are getting more comfortable in special apartment, you're going to see more transaction. There's a lot of dry powder in real estate, right? So people are now allocating more to real estate, investing more to real estate. So I think apartment, you're going to see more and more transaction there as well. And office, we have to kind of continue to monitor over the next 2 quarters. How is the reopening going to look like? And retail, there's definitely a positive sentiment on the grocery side. Still the big unknown on the mall side, right? So still continue to be kind of question mark on the mall side. But overall, I think real estate is going to be doing pretty good in the near term.
So overall positive, and with retail, it's when is it too cheap to ignore is maybe the takeaway. So thanks a lot, guys. Very helpful. Thank you, everyone, for joining, and look forward to seeing you on August 5th for the second quarter results. Thank you.
Thank you very much, everybody.